Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, January 4th, 2021. Happy New Year to everybody as we kick off the first trading day of the year. Want to go over a few things here. We're going to look at a couple different things. Every video I do, I try to have a theme, whether I'm covering a certain sector that's bullish or bearish, setting up, and the trade ideas within there, maybe a particular asset class, currencies, sometimes a broad market. And the theme of this video, I guess where it started out this morning, I was scanning the headlines, and the Wall Street Journal talked about they called it the everything rally. Will everything, which is pretty much everything rallying into year end, stock markets, Bitcoin, commodities, you name it, and will that continue into 2021? So the theme for this video is what I'm going to call the everything setup. What I'm going to go over, I'm not going to go over a gazillion different things. I'm going to go over the major asset classes. I'm going to go over the stock market, just briefly hit on the indexes, Treasury bonds, currencies, and briefly commodities, and talk about how we have at this point in time, to me, beautiful looking setups. And it's not mere coincidence that all these key asset classes are set up. Where I'm going with this is, if and when these setups trigger, I think they're all going to trigger in close proximity. For example, when the stock market goes up, bonds tend to fall, and vice versa. So we have we're set up for a trend reversal. Make it very simple. I've been talking about for a while. A setup is just that, an untriggered trade or a reversal pending a certain catalyst. That would be, for example, let's start out with the broad markets here. So here's a 60-minute chart. This is more shorter term, not so much short term, short to intermediate term analysis. I'm not going to go over all the different time frames. We're going to start out with the 60-minute chart. Same chart I covered last week, heading into the end of the year. There's two levels I'm looking at on QQQ. To me, the Qs is or the Nasdaq 100, which it tracks, one of the most important indexes, because you have your market-leading tech stocks, FANGs, and all that. So we continue to make these divergent highs, little divergent highs, little correction, little minor trend line breaks, but all the while we're wedging higher. So what you're looking at here, and again, I have alternative trend lines here. This first one, the white trend line, which could do the trick, and then the yellow or the blue trend line, which I call the BOD, or benefit of the doubt trend line. In other words, that first trend line could break, but you have a lot of reactions on this one. So I think when this one goes with conviction, that'll be impulsive drop, and I think it'll probably be that once we take it out, and or a solid 60-minute close. Sometimes you can whip down through there. Maybe the S&P 500 hits support at the same time and reverses. So again, you'll know an impulsive breakdown when you see it. You'll see it selling. And all these are the same levels. I've been highlighting for weeks now. We need that catalyst. We need the sell signal to move down to any or all these targets. My minimum target, again, from where we're at right now, about a little over 300. That's about a 4% drop. Not much, but again, should this trigger, and everything else I'm about to show you, I think it has bigger implications, much larger implications on the stock market and other asset classes. So a lot of trading ops in this video as well. Let's look at the futures real quick. I started with QQQ, so I'm going to try to stay on task here and dig up NQ, Nasdaq 100 for you futures traders. Same story. I have the alternative trend lines. There's the blue BOD, benefit of the doubt trend line. There's a white trend line that comes off the early November lows right there, and that should break of this. And if you look real closely here, I'm going to add a line. You have some horizontal support. You see all these reactions here. Again, we're looking at a 60-minute chart, 60-minute candles of NQ. Here, I could probably do this and make it a little bit more clear for you guys. Here, if I click on this, yeah, it turns to bars. Okay, so you can see the levels right there. You can see the potential targets. Freeze the video, zoom in, and those are potential targets. Oops, only thing I need to do to update this chart is just lift that divergence line. We had divergence heading into the end of last week, and that divergence has only extended into this morning. So there it is. Beautiful looking setups in my opinion, and just needing that little nudge, that little catalyst. And I'll tell you, with everything about to go over, I think if and when all these breakouts or breakdowns trigger, I think it's going to be a very fast movement because of all the different asset classes that are aligned right now for a nice trend reversal. So I think you'll see a crowded rush for the exits if and when that comes. So we're again, a lot of the headlines heading into the end of the year, been coming increasingly bullish. Sentiment is through the roof right now. Very bullish sentiment, and I'm going to get to some of those in a second. So there's your levels. There's what we need. Boom. Breakdown one, breakdown number two. Of course, a break of that support would open the door for more downside. At bare minimum, I'm looking for a move down here to that 12,409. And we'll call that 12,410, then 230. That is right there. 12,230 right there. Those would be near-term minimum targets right there. Expect a reaction on the first tag of that one there, and drop down to here after that. All right, next up, let's look at the S&P 500. Try to go through this a little faster so I can cover everything and not make it too long a video here early in the day. SPY right there. This is the best trend line, I think, on SPY right now. We could probably do what we did on the Nasdaq 100, maybe take one off the early November lows, like I had on the Qs. There it is. So there's your trend lines right here. And we'll color up this one blue. They come in very close proximity. Whether you take that one I drew off the early November lows or this one here, we're going to break both around the same time. And yeah, any or all these potential targets. I may need to update SPY, give you some other levels. I'll try to do that in the next video or post a chart, a screenshot of that. ES, for you futures traders, let me dig up my ES chart. Got it down here somewhere. There we go. This is what it looks like. This is a 2-hour candle period chart. So every candlestick is 2 hours of trading. Here, I'll flip it over to bars. You can see it a little clearer. So this looks to be the trend line right now. It's a little minor trend line there. There's a secondary uptrend line, and again, they come in roughly together, and you can see potential targets here on ES for you ES traders. All right, so that's what the broad market looks like, and I know some of you like to trade the small caps. I think the small caps are poised to probably outperform on the downside, probably get more bang for your buck. They're really, really overbought and overvalued. Well, like what isn't right now. So I could draw various trend lines here, and again, I think they'll all go together. So we'll use that trend line in that about that 192.86. I think that's the safe level. When that goes, I think we'll be in correction mode. And again, I think it'll probably happen fast. I think you'll see a pretty quick rush for the exits if and when all those levels go, particularly the large caps. We want to see the S&P 500 and the Nasdaq 100 break down. And RTY, let me dig that up for you future traders. All right, this is the small cap Russell 2000 futures. This is hourly bars right here. So 1 hour candles, 60-minute candles, and there it is. There's your, we've been wedging higher. I mean, it's the same story everywhere. Divergent high, little correction. The divergence continued to build, and we're below that divergent high right now. Starting to move lower in the small caps, but just a little more downside should do the trick and open the door up for a move down to these targets. Okay, so that's how the equity markets look, and remember the trend is bullish until we get those sell signals, and those are the ones I'm looking for. What I just showed you, those trend line breaks on mainly the S&P 500, Nasdaq 100, and at the very same time, Treasury bonds are setting up. Treasury bonds typically move inverse to the stock market, Treasury bond prices, and especially during periods of corrections, that's when traders will flock to the safety of U.S. Treasuries, particularly institutional traders. Just like that meltdown, you can see right here that parabolic spike, huge run up in Treasuries into the March lows. Fed came in with the nuclear option. You can see the sell-off in Treasuries, and since then they've had a heavy hand in the Treasury market. But again, right now, just like the stock market is set up on the verge of those, breaking down. Hasn't done it yet, but once it breaks those trend lines, I think you're going to see around that same time, maybe shortly afterwards, Treasuries break. Sometimes you'll see Treasuries lead the way, and a lot of experienced, seasoned traders will look for clues in the Treasury market. Again, The Fed has had a a very heavy hand in the bond markets, not just treasuries, corporate bonds as well. So there is has been some distortion in the charts. However, I think if you see the stock market start to correct and we get a decent correction, you're going to see money moving into treasuries most likely, and that would be a breakout above this trend line here in TLT. So we'll just run through some of the different ETFs. You have TLT we were looking at. That's the long bond. They hold 20 to 30 year. Those are the longest treasury bonds issued. This is IEF. It holds 7 to 10 year, and you can see the same thing. There's a trend line right there. Even better would be to look at the treasury yields, and you can look at TYX. Okay, TYX is the 30-year treasury bond yield index here. So you can see two lines. I have two very important lines. I believe this key downtrend line. Lots of reactions. That's a downtrend coming off the 2018 highs right there. And you can see yields have been falling. They plunged into that March sell-off again. The yields move opposite of bond prices. So this is the inverse, if you will, of that TLT chart I just showed you. And so what you're looking at here is a nice setup in yields. Now they're going to break one way or the other. That's the one thing about it. They could break to the upside. There's a big level right here. I have a lot of reactions here, around 1766 on this index. That would be a bullish breakout to the upside if it was, anything other than a little whipsaw signal. Just as a downside break, and this would coincide with a breakdown in the stock market, a sell-off in the stock market. It would be a break of this trend line. So again, very well-defined trend line. There's your first support level, and a second and a big support level down here at about 1160. That's TYX, again, the 30-year Treasury bond yield. TNX is the 10-year Treasury bond yield. Same thing. And again, remember, the theme of this video is just these setups, the everything setups. Looking at a lot of what I'm going over. Again, I'm not going to go over everything in the financial markets. There's assets galore. These are the big ones: the stock market, treasury bonds, and again, we'll look at commodities, a couple other things here. But there it is, beautiful trend line right there, uptrend line, and we're pinched. Treasury's about to do one thing or the other. When you look at the 10-year right here, again, to me that is a big resistance level. There's a very important downtrend line up there. They could do this, and that might coincide with a big rally in the market early, a January rally. Maybe we don't get those breakdowns. So we rally up and hit that trend line, then reverse, and then go on to break that. So that scenario, again, a spike up in yields, followed by a reversal off that trend line, then ultimately breaking down, would just what that would most likely mean is we're going to get a nice correction in the market, but it might come in a couple weeks. So I don't consider this wishy-washy analysis, saying that, yeah, we can go up or we can go down. I'm giving you the levels that show when we're likely going to go up or down. If and when we break out in treasuries here, or break down in treasury yields. And again, you want to see a breakdown in yields confirmed with a breakout or breakdown in the stock market. So that's it. And then quickly look at the futures, because again, two things. This is if you want to trade treasury bonds, you can use those ETFs. They're not going to move much. Treasury bonds, because they're relatively secure, percentage terms don't move anywhere near what the stock market does. So you can take a bigger position size if you're trading TLT or IEF or any of those. Or if you trade futures, then you can trade treasury bond futures. This is ZB. Again, these are long-term bonds. So this is comparable, if you will, to that TLT that we looked at earlier. And again, just a beautiful looking setup. Now this is a daily chart. So these are daily candles. And you can see this downtrend line right here. Very well defined on treasury bond futures. In fact, we could draw a little smaller trend line there, and that gives us this little symmetrical triangle pattern here. So a pop up would mean bonds are rallying, and typically if the stock market isn't falling at that time, if it hasn't broken out, that may be an early indicator that we may be looking for at an upcoming sell-off, because this would show mostly institutions moving into treasury bonds in anticipation of breakdown. In other words, the smart money tends to trade treasury bonds much more than the retail crowd. The institutional investors is what I'm talking about. smart money. So there it is. There's your levels, and again, you can trade it. There's a first target about 1751.28, and if things get really ugly, and they could, then we're probably going to head up there to that 180 level. That's a pretty big 182.71 right there. So there's your levels on or ZB. I'm sorry, 30-year Treasury bond or long-term Treasury bonds. And that would be a breakdown that would bring yields or the bond prices much lower if we took out that 1700-ish level. All right, so that's ZB, and then finally just look at the 10-year, and now I'm down to a 2-hour, 120-minute candles. Here, we'll go back to this. So there it is. And just again, nice symmetrical triangle. So this tells me in bonds, you can see volatility was high here. Prices have been compressing. And this is the nature of a lot of chart patterns, whether it's a bullish falling wedge, which you guys know I love to trade those wedges, whether it's a bearish rising wedge, a bullish falling wedge, symmetrical triangles. And the nature of those wedges, just like these triangle patterns, is prices are compressing, and this is like a coiled spring, and spring being pushed down and building energy. Might not look like it. People get lured into a false sense of security with the stock market volatility low, stocks grinding higher and higher with decreasing volatility. Same thing here with these treasury bonds, and then boom, once you break out, and it can go either way. And again, that's why I'm showing you the levels. You're probably going to see a pretty good move, pretty sharp move, and that's why I think if and when we get these sell signals and buy signals on these different asset classes I'm covering, I think things can move quick because again, a lot of things are setting up, appear to be setting up for a pretty good move. Okay, so we covered stocks and treasury bonds, and finally here's the dollar. I've been talking about this for a long time. The dollar setting up. We have divergence that has been building. This is DX, the US dollar index futures. We're looking at hourly charts, each candlestick. It's hard to see them here on bars right now. Yeah, I'm on candlesticks, or these are bars. But each one represents 1 hour of trading, and you can see here we had this breakout right here. We've been back testing the primary. Here's our primary downtrend line. This comes off that early November lows. Remember those trend lines on the 60-minute charts of QQQ and SPY? This is comparable. That's where the dollar had peaked back here. And since then, here, I'll flip over and show you real quick. Let me go back to NQ. There's my primary uptrend line on NQ. Comes off the early November lows, right? Stock market's been moving higher since, and at the very same time, go back to the dollar index, that is the same period of time, the early November highs in the dollar, and the dollar's been falling. So therefore, one can only deduce that at least in the past several months, there has been an inverse correlation between the stock market and the US dollar, right? Dollar's been falling, and dollar's set up very bullish right now, big divergences. Small divergences often lead to a small rally. Big divergences often lead to a big rally. Especially, this was just a random divergent low within a downtrend. There was no trend line. Well, there was a little minor trend line there that was taken out. This is a much larger, much more significant downtrend line. And again, we've been back testing it with this minor trend line right above. So boom, pop. And again, I think these all are going to trigger around the same time. You're going to see a stock market break down. You're going to see impulsive selling. You're going to see the dollar break out, impulsive buying, and bonds as well. And a couple other things. If you want to trade it, there's DX, dollar futures. You can see my target I've been talking about for a while. Minimum target up there, about 91 and change. E7 is your euro futures. Euro is almost basically an inverse of the dollar, only because we're looking at the dollar index before, and that euro is the biggest component. And here are euro futures, E7. I have a trend line here with a lot of reactions, and then a BOD, a benefit of the doubt trend line, and not by coincidence, that major reaction low in the euro came back in early November as well. And we've been in an uptrend. So here, this has been positively correlated with the stock market. Also, both of them rallying off those November 2nd lows. One reaction there, another, and another recently, and same story. Just like the dollar is in that bullish falling wedge pattern, the euro is in this bearish rising wedge pattern with a sell signal to come on a break below this secondary trend line, or the bottom trend line, BOD trend line. If you trade E7 euro futures and you want to short them, that's first target there is 1.2091 and then 1.1952. There's the levels right there. And again, all lined up, all set up, poised, not by mere coincidence, far from coincidence in my opinion, that you have the bearish rising wedge on the euro, bullish falling wedge on the dollar, comparable trend lines on Treasury bonds, and the stock market. And if you don't have futures, and you can always get those futures charts. Investing.com will give you free real-time futures charts if you want to check the dollar futures, anything like that. Or a lot of charting platforms will have the euro-US dollar pair. And what you want to see there is, well, we've already seen it. We have this trend line here. We'll give a secondary, let's do a benefit of the doubt trend line now that we have a couple reaction points there. What I'm doing is zoom in real tight and show you what I did with that. That was the trend line that I had. We broke down and we back tested, but I have 1, 2, and now 3 reactions. So this is the trend line that needs to go, and that would align with what I just gave you on the euro futures there as well, and that secondary trend line on dollar futures. So there it is. Everything's set up, ready to go. Let's look at one more chart here. And this one I've covered quite a bit in the past, not so much lately, not in the last week or so, but I have not forgotten about this. This is one of my favorite charts. I just love this one. I always say there are no guarantees in trading, investing, but this one has been very, very accurate. This is the CPCE, the put to call equity only put to call ratio. So this is showing a ratio of put buying versus call buying, and when you get up to the green line here, that's my buy signal, and there's extreme bearishness. You see this during corrections. This is when you want to step in and buy stocks after a correction. When you see extreme fear, this means there's a lot more people buying puts than are buying calls, because everyone's freaking out, thinking the world's coming to an end, the stock market's going to keep going down, and that's when you want to step in and buy. So during corrections, watch this one. Last time you had a buy signal was right here at the March lows, and it proved to be, as each of these I'm circling, were some of the best buying opportunities in decades. This was the last bear market. Now keep in mind, even if you stepped in, you had some nice bear market rallies. You might say, well, this is, you can look at it as an investor or an active trader, swing trader, and there was tremendous money to be made on those bear market rallies. And then this is where that bear market in 2009 ended in March lows. So, and then flip it down here. Now forget about that. We're not looking at any buy signals. The market's long since you passed that last buy signal. So this is what I do every day. I wait patiently. I look at this and I say, here were the only, in going back in decades since the last bear market, the biggest corrections that we've had, these are the arrows, that's when the signal triggered. The biggest corrections, or some of the biggest corrections I should say, were preceded by drops down to this extreme bullishness complacency. And I often talk about this. Sometimes it's a one and done reading, and sometimes you have what I call clusters. When you have multiple readings in close proximity, that shows a persistent level of extreme bullishness, and that's what we have. So there it is. You can see that we keep pushing the needle here. Investors are and have been extremely bullish, a lot more call buying than put buying. That's why you have a very low put to call ratio reading. And again, I would most certainly say, I wouldn't say this is not working because we haven't had a sizable correction yet. If 6-8 months go by and we see this ratio abate, in other words, prices move back up, and we don't have a sizable correction, then I will say, well, this was certainly a false signal. As of now, this is one of the most powerful signals, again, because it's extreme readings in close proximity. Let me show you one more. So that's equity only put to call ratio. And this is a total put to call ratio. So this one will include index puts and calls on indexes as well. There's my green line. I don't have it colored up here, but there's excessive fear, go long, cover shorts. This is when you want to go long. after corrections. That's, you can see right there was at the bottom of this 10% or so correction. There was the bottom of that before that nice rally there. You got another one right there at the end of that. That was a near bear market back in 2016, 17. Again, well, look, you can see the spikes. There was your last buy signal back in March at the lows. But what we're looking at here, you can see here was a cluster. There was a one and done, and it shows the drops. Back there was a sell signal before last bear market that was followed by a 56% drop. Again, that was a bear market in the 2009 lows. 18%, 21% drop, 10%, 16%. There was a no correction, so I'm going to point out that unlike the CPCE that had 0 false signals in the last decade plus, this one did have a cluster of signals that didn't result, at least not in a sizable correction. We did have a drop there, a near reading, but boom, the last time that this signaled was just before that plunge into the March lows. So there was a lot of technical evidence. COVID hit. COVID certainly exacerbated the sell-off earlier last year into the March lows. But again, by all technical measures, we had trendline breaks, divergences, everything I'm covering now. We had similar signals back then. So again, COVID may have exacerbated the rate and the magnitude of that sell-off, but it was priced into the sell-off itself. The correction was most certainly priced into the charts technically. It wasn't just random, at least not from a technical perspective. Fundamentalists will say it's random and assign it solely to COVID, but again, it was in the charts. And so since then, we had 36% drop. We have persistent readings, and including one big spike last week. I don't know if you can make it out there. You can pull this chart up on stockcharts.com. There's a symbol, $CPC, and you just had an extreme low reading again. So it's just like these other clusters in the past that were followed by double-digit corrections, either one and done or a cluster like that. So that's about it. The only other thing I wanted to show you, 2 other charts, and we'll wrap it up. I'm actually, as you know, been bullish on commodities, but one of the things I think we're going to see this year, this is just sidetracking, it's not so much a setup, although I do think there's a correction coming. I think the broad-based commodity ETFs like this one, this is GCC. This has everything that I've covered, all the commodities. You have agricultural commodities, you have things like livestock, grains, you have precious metals, you have oil, and I think crude oil is going to drop along with the stock market, and that'll put pressure on these broad-based commodity index funds. So there is a setup. There's your trend line right here, your benefit of the doubt trend line. So once that breaks, you can short GCC if you care to, or crude. But where I'm going with this also is when I look at these broad-based commodity index funds, I think a theme that you're going to see heading into 2021, the Fed has pretty much pledged to keep rates at or near 0 for the next 3 years. To me, that is insane for them to even make a statement like that. If there's one thing I know about the Fed is that they are reactive, not proactive. And to try to say that they're going to be able to keep rates at 3%, what I see and what I've been talking about, and I think it'll be an increasing theme you'll start to hear more about this year, is inflation. I've talked about how I've been overall bullish on commodities. They've had a nice run off the lows in 2021. Food is one of the largest inputs to the consumer price index. And the Fed, the reason that they've been able to keep rates so low for so long since the last, bear market, is that inflation has not reared its ugly head, or at least by their metric, consumer price index. But we all know, you go to the grocery store, your grocery bill has been going up, the price of cars, and I covered a video on boats, everything. A lot of things have gone up. They're certainly creating an asset bubble in the stock market, Bitcoin, things like that. So there's a lot of asset bubbles. And the one that's going to really put the checks on things, Bitcoin isn't going to cause the CPI to go up. But what will cause it to go up are increasing commodity prices, all types of commodities, including crude oil, of course, and then the housing market. And I want to just say this before I get off GCC, because this is a broad-based commodity index fund, as I just showed you. This was a primary bear market downtrend line. This goes back to 2011. We had a major peak back there. It was a little higher back here in '08, but you can see a nice, clean downtrend line. Bear market downtrend line which was taken out recently. So this is one reason I'm longer term bullish on commodities. I think we'll get a correction in this one, like I said. And there's a trend line that you could trade it down to. Zoom in, an uptrend line that I think we'll come back to at the very least. But this is a breakout of a bear market downtrend line, and that has longer term bullish implications. The other thing, and then we'll wrap it up, to just kind of stay on my theme of inflation and why I think the Fed isn't. You'll start to at some point hear them talk about concerns of inflation. They'll slowly talk the market down or talk themselves out of their pledge to keep rates low for for the foreseeable future, for the next few years. And that'll be things like this. This is the other big component of the consumer price index, is housing costs. Whether you're renting, this is a home price index. Now, you can pull the same thing on rental. I can tell you, we all know it's been going up like crazy. The stock market, the housing market, especially in certain markets like Miami, that's where I'm from originally. Crazy, insane prices on the homes right now. And what we're seeing here, this is a spike. Look at that trajectory. Look at that sudden spike up. And what this yellow, if you can make it out in the video here, let me see if I can expand this chart for you. One sec. Okay, I think that works. All right, the yellow shows we're in a recession, yet, the stock market's going up, the housing, and not just going up, strong. The housing market is going up. I'm trying to draw on this, and it's not letting me do that. One second. Okay, try this again. I think I had part of the chart cut off. There it is. So there it is. This yellow, shaded yellow area here, is telling us we're in a recession, yet the housing market's been going up like crazy. Typically during recession, housing prices fall. These shaded gray areas are the last few recessions. There was an exception back after the dot-com bubble popped. Housing prices continued to go up, but this is what we're looking at. And again, I'm going to wrap it up here just saying these are kind of, well, what I did is showing you setups. The theme of the video was showing you a lot of things are set up just right there on the verge of either breaking out or breaking down. None of those signals have triggered yet, and they could trigger today. They could trigger 2 months from now. So we'll watch those levels, and then going into 2021, this theme here, I think you're going to hear more and more about is inflation, the inflationary effects of the kind of unintended or intended consequences of excessive easy money, rates too low for too long. The asset bubbles in the stock market. The Fed wants that because that increases consumer confidence. What they don't want, and housing price, they want the housing market to hold up. But when you get prices out of reach for a lot of people, and again, it's going to trickle down, and sooner or later you're going to see this in the CPI. You're going to see rising food prices, rising gas prices, energy costs, and all that. And then all of a sudden, that's when, and it may take a while, but that's where the Fed's going to start backing off their zero rate policy to keep inflation in check. All right, we'll wrap it up here. Again, Happy New Year to everybody, and if I see anything else that stands out, anything I forgot in the video, I'll get that out to you, or I'll post it out. What I'll often do is post in the comments section below any of these homepage posts, any follow-ups, or anything I might have missed. And this has been Randy Finney with Right Side of the Chart. Have a great day.